Hello, before we start today's video, just a quick note that if you are interested in purchasing this indicator, just simply email us at daytradinggps@gmail.com to request a discount promo code. In return for you taking your time for watching this video today, you can email us and request a discount promo code that will give you a substantial discount on the purchase of the indicator. All of our indicators are sold on a one payment for lifetime access basis. Thank you. One more thing before we get started, you'll see in the description of the video there will be this section here, which is click on this link for descriptions links to the other videos mentioned in this preview on different topics about the SPX indicator. So this is a Google Drive link. I'll show you where it takes you to now. So when you click on that link for the Google Drive, this is where it takes you to, which as you'll see is a list of different topics and links to the videos on the specific topics. These topics go into more detail. We may reference some of these topics very briefly in today's video, but when we reference to go look at the video that provides more details, then you'll just simply click on this link and go to here, and then you'll be able to click on the link that you want to see a more detailed video on a certain topic. Thank you. Hello, in today's video we'll be taking a look at the Friday, November 21st, 2025 trading session for the CBOE SPX index. We'll be utilizing the day trading GPS SPX Daily Key Levels indicator for our trade entries and managing our trades, and we'll be specifically using the newest version of this indicator, which was released a few weeks ago, the V2.0 version of this indicator. Okay, so some of you may already be familiar with seeing a lot of our videos on our YouTube channel about how this indicator works and what all the different levels mean. And some of you may be new to the channel and seeing this video on the SPX Daily Key Levels indicator for the first time. So I will briefly run through some of the aspects of the indicator. This video is going to be a shorter video than we normally do, so if you'd like to see a more detailed video on all the aspects of this indicator, please look in the description of this video for the other SPX session videos which are on our YouTube channel that you can take a look at as far as getting a more detailed overview of how this indicator works. And there's also a link in the description of this video, which is a Google Drive link, which is also on specific videos for specific detailed topics on this indicator as well. So if you click on that Google link under additional resources, it'll take you to a Google document that'll have several videos on that are go into more detail on specific topics concerning the indicator as well. Okay, so this indicator is made for day trading SPX index options on the SPX index. It works on the TradingView platform, and it works on two specific SPX symbols. So the main symbol that it works on is the one that you see on the chart now, which is the SPX symbol under the CBOE exchange. So if you go to TradingView and you type in symbol search and you put in SPX, then you will look for the SPX symbol under the CBOE exchange, and that is the official SPX index that everyone follows. Also, this indicator works on a second SPX symbol for those who trade Forex or are taking a Forex based trading challenge and prefer to trade SPX not using SPX index options, but instead using a Forex CFD version of SPX, which I'll show you now. Okay, so that symbol is SPX 500 under the 8-cap exchange. So in TradingView you would type in SPX 500 and then you would look for the SPX 500 symbol under the 8 cap exchange. So these would be the daily key levels for that Forex CFD SPX 500, along with the levels here on the chart. And then as an added bonus, you also get the CBOE SPX values here for the official SPX index on a second table here. So the advantage of this is that you can get the levels at 9 a.m. Eastern New York time, which is 30 minutes before the open of the CBOE SPX index. The way TradingView Pine Script coding works for indicators on TradingView is that even if your indicator already knows the levels for a symbol, which in this case for CBOE SPX at 9 a.m. Eastern, the CBOE SPX index does not trade in the pre-market or overnight, unlike the Forex CFD. And so even if the indicator already knows what the levels are, if you have your chart on CBOE SPX, it will not display the levels until that index opens at 9:30 a.m. Eastern New York time, which will be the same levels you see here in the second table. And then this allows you to get the levels for that index 30 minutes before the open at 9 a.m. So as an example, here at 9 a.m. on the open of this candle here, then you would get this chart here as you see, and you would have this second table here, which would allow you to get those levels 30 minutes early. For trading SPX 500 under the 8 cap utilizing this indicator, that would be again for either trading a Forex through a Forex broker if you have an account with a Forex broker and that's how you prefer to do your trades on SPX, or if you're taking a trading challenge through FTMO, Apex, the 5%ers are one of the 60 or 80 companies that provides trading challenges in which you can pay to take a trading challenge, and if you pass that trading challenge, they will fund a live trading account for you, and then you do a profit split with them using their risk capital instead of your own. All right, let's go back to the other chart. Okay, so we're back on the main CBOE SPX index. So the majority of people that use this indicator are using it for trading SPX index options. So again, this is the symbol that you would use for trading SPX index options. As you can see, we're on a 2-minute chart. That is the recommended chart time frame for utilizing this indicator and utilizing the daily key levels day trading strategy, which we're going to show you in this video today, and it's the same strategy that you will see in all of our SPX trading videos on our YouTube channel. The recommended chart time frames for this indicator for this particular strategy are between 1 minute and 5 minutes for day trading the index options. However, as you'll see in all of our trading videos, we utilized a 2-minute chart because we have found that to be the most consistent chart time frame for this particular strategy. However, if you prefer a different time frame between 1 minute and 5 minutes, you can utilize the indicator for that as well. It's just that the 2-minute is found to be the most consistent for this particular strategy. Okay, so at 9:30 a.m. Eastern at the New York Open, on the first tick of the New York Open, for the CBOE SPX index, you will get the daily key levels on your chart as you see here. The most important level that the indicator gives is the daily bull bear key price level, which is bull bear KPL level, which for Friday's session was 65.6682. This is your important bull bear pivot for the session, and which gives you the initial bias for the session based on the opening 9:30 a.m. candle, which is an optional trade under this strategy. You'll also see these midpoint levels here above and below the bull bear key price level, the QL and also the QL levels above and below. The QL above and below are your tight stop losses on either a bullish trade. So on a bullish trade, the QL below would be your tight stop loss on a bullish trade from the bull bear KPL. Your QL above is your tight stop loss on a bearish trade taken from the bull bear key price level. Your midpoint level above the bull bear KPL is your standard stop loss on a bearish trade on the bull bear KPL, and your first midpoint below the bull bear KPL here is your standard stop loss on a bullish trade from the bull bear KPL level. Also, you'll see the main levels above are R1 through R6 and S1 through S6 below the bull bear KPL. I will show you a screenshot of all 6 levels now. Okay, so here's a screenshot of all 6 levels. As you can see, if you have all 6 levels on your chart when you're first trading in the first part of the session, it will compress these levels here, which are very important for trading off of the bull bear KPL, as that is the most prevalent trading level during the initial moments of the session and typically during the morning part of the session. So it is better to expand your chart out to have either R3 down through S3 or R2 down to S2 or some combination thereof rather than having it compressed. Also, I wanted to show you all 6 levels because here is the YDH level, which that is yesterday's daily high. So the other key levels besides the main R1 through R6, the bull bear KPL, and the S1 through S6 are the YDH, YDC, YDL, PML, and PMH. So your PMH is going to be your pre-market high, the PML is your pre-market low, the YDL is yesterday's daily low, specifically the RTH session low. YDC is yesterday's daily close, specifically the RTH session close. And YDH is yesterday's daily high, specifically for the previous day's RTH session high for SPX. As you can see here, now we've drilled down to where we have R3 through S2, and we've included the PML level. So as I stated, it's best to drill down and expand your chart by simply dragging your mouse and expanding the levels so you get a more granular view of, say, R3 through S3 or R2 through S2 or some combination thereof, as it is most important to see a more granular view, especially in this range here, as these are the most important levels during the initial part of the session. With this indicator, you can take bullish and bearish trades off of each of the main key levels. So, for example, the main key levels are going to be the bull bear KPL, R1 through R6, and S1 through S6. The midpoint levels and the QL levels you do not take trades off of. Those serve other purposes, as you'll see as we go throughout the video here. So we do have a video on taking bullish and bearish trades off of any of the main key levels. So as you can see, as the session progresses, the other levels come into play. It's just at the beginning of the session, typically the bull bear key price level is going to be the main trading level during the opening moments of the session. If you'd like to see the video regarding taking trades off of the other main R and S levels as well, we have a video on that is in that Google Drive link that I explained earlier, which takes you to a document of various topics that has detailed videos on various topics, one of which is taking bullish and bearish trades using this indicator off of the other main R and S levels as the session progresses. Also, that video also goes over the 2 different types of trade entries with this indicator. One is a standard trade entry, whether bullish or bearish, and the other is a more conservative trade entry, which takes additional confirmations, whether it's bullish or bearish. And that video goes into detail about how to recognize each of those different trade entries and shows several examples of them. So if you'd like to see that video, simply click on that Google Drive link, go to that document, and look for that particular video. Okay, so on the opening candle here, we have the 9:30 a.m. opening candle, which is this candle here on the 2-minute chart. As you can see, the candle opened below the bull bear KPL level. But we have this large wick which intra-candle price traveled above the bull bear KPL. However, it came back down and closed below the bull bear key price level. So even though this is technically a green candle, it does close below the bull bear key price level. So if you're taking the 9:30 a.m. opening candle trade with this indicator, this is your bearish entry signal for taking a trade off of the bull bear key price level. The most important aspect of the opening trade candle is where is this candle closing. So for example, if this candle had done the same thing except it had instead traveled above and closed above the bull bear key price level, then instead we would have a bullish entry signal on the 9:30 a.m. opening candle. The most important aspect is where is this candle closing, not necessarily where it is opening or intra candle, but most importantly, where is it closing? Is it closing below the bull bear KPL or closing above the bull bear KPL? Also, another important aspect is the acceptable range. So on taking a trade from either the bull bear key price level or any of the main R or S levels, there is an acceptable range of which you can take the trade based on the close above or close below those levels. And that acceptable range is also discussed in a video in that Google Drive link, specifically on the topic of the 9:30 a.m. opening candle and 9:30 a.m. opening candles to avoid if the candle is closing out of range. And there's also a PDF document that goes along with that video which explains the acceptable range and then what is considered out of range. The same acceptable ranges and unacceptable ranges also would apply to the other main key levels as well. So that would also be an important video for you to take a look at, as it also explains on your trade entries what would be an acceptable range for a closing candle above or below either the bull bear KPL or taking bullish or bearish trades off of either the main R1 through R6 levels or S1 through S6 levels. So this one is within the acceptable range to bearish trade. Now, what about as far as strikes, the SPX option strikes for this particular bearish trade? So on this indicator, for any bullish or bearish trade off of any of the main levels, there are always going to be 3 different option strikes that you can consider for any of those trades. So for example, with this particular trade, it's off the bull bear key price level. It's a bearish trade. And so our standard play with the daily key levels option trading strategy is going to be an at the money option of a strike price that is closest to that level's price for today's session. So this is 65.6682. The closest SPX strike is the 65.65 strike, and since it's a bearish play, it's going to be the 65.65 put. So the price on the candle close here, we had elevated volatility this week, so we had high IV, so the options are priced a lot higher than they would be normally under a low or normal volatility session. And the price on this 9:30 a.m. candle close for the 65.65 0 DTE put option is $37, which, as you can see here, this is a thinkorswim data box on a 2-minute option chart for this particular 65.65 put with an expiration of 11/21 for 0 DTE, and the close is $37. If you're not familiar with how options work as far as pricing, you basically take the price of the option that you're paying and you multiply that times 100. So the price of one option for one at the money 65.65 put would be $3,700. So if you bought two of them, it would be 2 times 3,700, 7,400. If you were buying 5, then it would be 18,500 because it would be 5 times 3,700. Now, what about as far as the other option strikes? I said there were 3 option strikes you can consider on any bullish or bearish trade. So here we have 2 out-of-the-money strikes that you can also consider on this bearish trade from the bull-bear KPL. How you figure out with this indicator what are the acceptable out-of-the-money strikes are as follows. You take the level that you're taking the trade from, in this case this level here, the direction that you're taking the trade, a bearish trade. So we look down to the first midpoint level below the level we're taking the trade from, and that is 65.53.66. So the closest strike price to that is the 65.55 put option. The furthest out of the money strike you can consider on this trade from the bull bear KPL, a bearish trade, is going to be the strike closest to the first one full level below, which is the S1 65.40.50. That would be the 65.40 put option. So the price on the first out of the money strike, 65.55, is 32.07 on the candle close, and the price on the candle close of for the 65.40 furthest out of the money you consider is 26.40. Now, what about stop losses? The stop losses on this particular trade is, this is a bearish trade, so the tight stop loss is going to be the first QL, the QL level above the level you're taking the bearish trade from. So in this case, it's the QL above the BBKPL, 65.73.40. The standard stop loss is going to be the midpoint above the level you're trading on this bearish trade, and that would be this mid BBKPL R1, 65.79.98. With this indicator, your initial stop loss is going to be a level-based stop loss. Later on, if you're adjusting your stop loss, if the trade goes in your favor, then you will then switch to a price-based stop loss for your option, as we will see as we go through these trades. But your initial stop loss is going to be based on levels, whether you take the tight stop loss or the standard stop loss. And if you were taking, let's say, a bearish trade off of the R1 level, it would work the same way. You would turn on the QL level in the user control panel if you prefer to use the tight stop loss in a bearish trade from R1, and you would use that level, and the standard stop loss would be the first midpoint above the R1 level, as that's the level you're trading. If we were instead taking a bullish trade from the bull bear KPL, then our tight stop loss, if we prefer to use that, is the QL below the BBKPL, and a standard stop loss on a bullish trade from this level is the midpoint below. Okay, so the stop losses are going to be the same on this trade, whether you use the at the money strike, which is the standard play, or use either one of the out of the money strikes, because the stop loss is level based, not price based on the initial trade entry. Now, there are 2 different types of trades that you can do with this indicator. One is a scalp only trade, and one is what we call a regular trade. On a scalp only trade, you're looking for a one level move in your favor to close out all of your options on a scalp only trade. So on a scalp only trade with this indicator, there's no stop loss adjustment. You are simply looking for a one level move in your favor, and then you are exiting your trade regardless of how many options you're trading, whether you're trading one option or you were trading 3 options, 5 options, 10 options, or 20 options. It's still the same on a scalp only, 100% closeout. Whereas on a regular trade, you are looking for a bigger move, and the minimum threshold for that move is a 1.5 or 1.50 level move in your favor. Then once you have reached the minimum required 1.50 level move in your favor, then you have several different options starting at that level. Either 100% closeout of all your contracts, or adjusting your stop loss on all contracts to break even. At this point, you would be changing to a price-based stop loss, break even being the price you paid for the option, or break even plus a 10 to 15% profit buffer, initial profit buffer, which is simply adding on a to the price that you paid for the option. So if you paid $37, as we saw here, $37 would be just to break even, or you would make it $37 plus 10% of $37, or up to 15% as a profit buffer if you prefer to add a profit buffer. Or if you're trading multiple contracts, such as 3 or more contracts, then you can close out 70 to 90% of them and adjust the stop loss on the remaining runners you're leaving that you want to see a further move on to either break even or break even plus the profit buffer. And then at each succeeding level move in your favor, after the initial 1.5 level move, then you would have a same decision to make at each of the succeeding level moves in your favor, which we will go through and go through the rest of this as we go through these trades. Okay, so here you can see the standard stop loss on the bearish trade, first midpoint above, tight stop loss QL above. This is our entry candle here, and we are also entering on this candle. Now, you could have also entered here or here if you wanted to not take the 9:30 a.m. opening candle trade, as these are also closing below, and they are also within the acceptable range. However, the 9:30 a.m. candle is giving you your initial session bias, which is bearish. Okay, so here on the 10:20 a.m. candle here, on this candle here, this is the 10:20 a.m. candle, and on this candle it hits the S1 level, as you can see here, and this is your one level move in your favor, one level from the SPX bull bear key price level to the S1 level, that is one full level. So the one level move in your favor occurs here on the 10:20 a.m. candle. As you can see here on these candles here, if you took the tight stop loss, then you were stopped out. By using the standard stop loss, you were not stopped out. As you can see here, this wick went up to the pre-market high, but never reached the standard stop loss level. The standard stop loss is the preferred stop loss to use on any trade from any level. The tight stop losses are there for people that prefer using tight stop losses. Of course, with a tight stop loss, you're going to have less at risk. However, you are going to get stopped out more often using tight stop losses. So the standard play is going to be using the standard stop loss, regardless of whether you're using an at the money or out of the money strike. And that would also apply to any bullish or bearish trades off of any of the other main R1 through R6 or S1 through S6 levels. The standard stop loss is the preferred stop loss to use on any bullish or bearish trade. Okay, the profit on the at the money 65.65 on the candle close of this candle here, where it hits the S1 level, the 65.65 put option is 43.60, so that's $660 profit per option. The 65.55 was 37.80, that's $573 profit per option. The 65.40 is $30.20, and that is $380 profit per option. Then as you can see here, after that, it did attempt to make a move back up. It did not hit the standard stop loss on this attempt to move back up again. As you can see on this attempt here, it fell short, started closing back below, and then resumed its bearish bias here. in which on the 10:36 a.m. candle it hits the mid S1 S2 level here, and that is your 1.5 level minimum required move on a regular trade. So here is where you have all these different options here, either 100% closeout of all contracts, or adjust your stop loss on all contracts to break even, or break even plus a 10 to 15% profit buffer, or if trading multiple contracts, close out 70 to 90% of them. For example, if you were trading 5 contracts, you would close out 4, that's 80%, and then you leave one remaining runner. So you would close out 4 of them of the 5 at the full price here and leave one remaining runner, either adjusting the stop loss to break even or break even plus a 10 to 15% profit buffer, which in that case, if price starts moving against you, then you've already taken out all of your profit on the 70 to 90% of your options, and you just have the one remaining runner at which you have adjusted your stop loss. The 65.65 put option on the candle close here, as you can see on the bid here on the close 51.70, that's a $1,410 profit on per option on that. 65.55 was 45.40, that's $1,333 profit per option on those, and the 65.40 put option is 36.90, that's $1,050 profit per option on those. There's not really enough room to put all these data boxes for the different out of the money ones here, so we're just using the standard play, which is the at the money in these boxes here. Okay, so now we're going to move into the next trade, which is a bullish trade off of the bull bear KPL. And that trade occurs on the bullish entry at 11:28. So this is the 11:28 candle here. You also, as you can see, this is a cross above, close above the bull bear key price level. You also have these 3 candles here, which are also within the acceptable range of a bullish trade off of the bull bear KPL level. However, your initial entry is here. If you wanted additional confirmations, you could have waited for these candles here, as those are also within the acceptable range. However, with these 2 candles here, you'd be paying more for the option. With this 1 candle here, you'd be paying slightly less. So the standard entry here would be on this cross above, close above, and additional confirmations would have been here if you wanted to have that, as they were still within the acceptable range for a bullish trade off of this level. Now with this particular trade here, the at the money standard play is going to be the at the money call option closest to the bull bear key price level, so that is going to be the same situation here, 65.66.82. So that is going to be the 65.65 strike, just like it was here, except this was a bearish play. So now we have a call option. 65.65 call option is going to be our standard play for this bullish trade here. And then our 2 out of the money strikes, we're going to use the same process, except we're going to look above this time, and because this is a bullish trade, so we look to the first midpoint above the level we're trading, 65.79.98. So the 65.80 0 DTE is your first out of the money option you could use, and then 1 full level above 65.93.14 is the furthest out of the money strike you can consider utilizing. So you would not want to use anything more than 1 level away. So half level away in the direction you're trading is going to be the first out of the money, and 1 full level away is the furthest out of the money that you can consider on a trade. Now the prices on the candle close here for this, as you see, we have the data box here for the at the money, $30.93 for the 65.65. The 65.80 out of the money was $22.90, and the furthest out of the money, 65.95, is $16.30. Now, as far as the stop losses. The tight stop loss on this bullish trade from the bull bear KPL is the QL below. The standard stop loss is going to be the first midpoint below, which is this level here. Again, regardless of whether you use at the money or out of the money options, you're going to use the same stop losses on the trade, whether you use the tight stop loss or the standard stop loss, as the stop losses on initial trade entries are level based. Okay, so on this particular trade, we have at the 11:48 a.m. candle where it hits R1. So that would be this candle here. As you can see, this candle wicked up, hit R1, but we are basing the prices on the candle close. As you can see, it backed off after hitting that. So it's important with this indicator that you either use candle closes on your exits, or you can use price touches of the levels. The main point being that you consistently do one or the other. Our preference is to use candle closes rather than touches of the level. So on the touch of this level here, if you were instead using price touches, then you would close out on the price touch. If you're using candle closes, then you would get out on the candle close. So the prices on the candle close here for the 65.65 call option, 38.80, that's a $787 profit per option. 65.80, 28.80, that's $590 profit per option. The furthest out of the money, 65.95, $20.50. That's a $420 profit per option. Here on the 11:54 a.m. candle, it hits the mid R1, R2. That's this skinny candle here, which, as you can see again, it does hit that level, so that triggers the 1.5 level move. In this case, it did back off again and closed below it, and these prices are based on the candle close. If you instead went with the price touch, then you would have gotten better prices than these. So the 65.65 at the money is 47.50 on this candle close here, and that is 47.50, which is $1,657 profit per option. The 65.80 was 36.40. That's $1,350 profit per option. The 65.95, the furthest out of the money, was 26.60. That's $1,030 profit per option. Here at the 11:58 a.m. candle, which is this candle here, as you can see, this candle hit the R2 level. So now we have a 2-level move above the bull bear price level, which was the level we took the trade from. So again, 1-level move is the R1 from the level we took the trade from. Mid R1, R2 is the 1.5 level, and then R2 is going to be the 2.00 level move. So again, this is a regular trade. On a regular trade, the minimum ideal move is a 2-level move. So the minimum threshold, absolute minimum required move on a regular trade is 1.5 levels to have all these options come into play. Then as the trade continues to move in your favor, here we have the minimum ideal 2-level move. What that means is that on low to normal or medium volatility days, the extent of most moves that you're going to see are going to be 2-level moves. So that is why it's the ideal 2-level move. That applies to low to medium or normal volatility days, whereas on high volatility days, you are going to see moves typically that are going to be greater than 2 levels and can go up to all 6 levels and beyond. If we have extreme volatility, such as we saw with the COVID pandemic or with the 2007-2008 meltdown of the real estate meltdown and also the market meltdown from different firms, trading firms blowing up, like Lehman Brothers, etc., then in those extreme volatility situations, the V2.0 indicator will also go up to 10 levels. So in those you can turn on R7 through R10 or S7 through S10. The reason that they're not turned on by default is simply because on most days you are not going to see levels exceeding R6 or S6. But during extreme volatility, you will see levels that will exceed R6 or S6, and if that is the case, the V2.0 indicator, you can simply go into the user control panel and turn on the additional levels if we get into one of those situations again. So on this particular two-level move here, the prices on this candle close were 65.65 call option were 62.30. As far as the bid on the candle close, that's a $3,137 profit per option. 65.80 out of the money, $50. That's $2,710 profit per option. And the 65.95 for those out of the money was 38.70 for a $2,240 profit per option. Now, as I stated down here in this comment box, after the minimum required 1.5 level move, then you have options at each succeeding level move in your favor. Each succeeding level move in your favor is either a midpoint level or a main level. So after it meets the 1.5 level move in your favor, every succeeding main level, which in this case was R2, or midpoint level, which would be the mid R2, R3, or the R3 level, and also above, would be considered succeeding levels in your favor. Also, succeeding levels in your favor after the 1.5 level move can also be if any of the PMH, PML, YDH, YDL, or YDC levels are in the pathway after the 1.5 level move is met. In this particular session on a bullish trade, they are not. All four of these levels are below, and as we saw in the early part of this video, the yesterday's daily high YDH level is way above and out of the screen now, which I'll just bring it back in so you can see here. As you can see, this, so if price had continued to travel above, you would turn on the midpoint levels here between each of these levels, and then at each one of the main levels and midpoint levels, those are additional waypoints for additional decisions as to either closing out your trade or doing a further stop loss adjustment. Then, as you can see here with this YDH level, it is also in the pathway, so if price had traveled up through here and crossed this midpoint level, then the YDH level would also be a level for a waypoint for a decision, and then R5 after that, and then the midpoint above R5, and then finally R6. So in today's session, we did not get a move above R3. We only got a move to mid R2, R3. And that occurred on the 1:48 p.m. candle here, on this big breakup candle here, in which the wick hit the mid R2, R3 level, then it backed off slightly. And again, these prices are on the candle close, which in some cases will be to your favor, and as we saw in other trades, it will not be to your favor. The main point is to be consistent in either doing candle closes or price level touches, whichever that you prefer when using this indicator. The prices on the candle close here on the 1:48 p.m. candle close were 81.20 on the at the money. That's a $5,027 profit per option. The 65.80 was $67. That's $4,410 profit per option. And the 65.95 was $53.50. That's $3,720 per option. Here's the data box for the bid on the at the money 65.65 on the 2-minute chart for the 1:48 p.m. candle. As you can see here, if you had instead gotten on the high wick of this candle, then it could have been as high as $86. So on the touch of this candle, it more than likely would have been some price greater than 81.2, probably in the $83 to $84 range if you were instead doing price touches. And as you can see here, price did take a small dip here and then continue to try to push higher, but it could not reach the R3 level today, and price did eventually fall back down. So if you further adjusted your stop loss here on any runners, and you had any runners that were left in the trade here, then you were likely stopped out here going towards the end of the session. It's also good to be cognizant of what time it is when this hits here. So at 1:48 p.m. we have just a little bit over 2 hours left in the session. So in this case, you also have to be cognizant when trading 0 DTE options and you're doing intraday day trades of what time it is and how much time is left in the session, so you can make a decision as to whether you are going to take the risk of a fall off later on in the session, because as we move later in the session, the 0 TTEs will start to lose more of any time value they have left in them because the session closes at 4 p.m. Now with this indicator, another point I want to make is that you can also use 1 DTE options with this indicator if you prefer those over 0 DTE. You would not want to use anything outside of 1 DTE, because with this indicator it is a day trading indicator, and with that you are going to be opening and closing all of your positions within the same session, regardless of whether you're using 1 DTE or 0 DTE. The advantage of 1 DTE options is that if you have a move that is moving into the later part of the session, the 1 DTEs will retain more of their time value and will be less prone to more yo-yoing of the price back and forth in the later part of the session because of that time value still being there. Whereas with the 0 DTEs, if price starts moving against you later on in the session, they will move against you a lot more rapidly than the 1 DTEs will. The 1 DTEs also allow you to stay in longer with a move into the later part of the session if we're moving into the, say, 2:30 to 3 p.m. and beyond range versus the 0 DTEs. Okay, so that's going to draw this video to a close. As if you are interested in purchasing this indicator in return for you taking your time for watching this video today, you can send us an email at daytradinggps@gmail.com and request a discount promo code to purchase this indicator. And in return for you taking your time to watch this video today, we will send you a promo code that will give you a substantial discount on the purchase of this indicator. All of our indicators are sold on a one payment for lifetime access basis. What that means is that you make one payment and then you have access to the indicator for life. It is not a monthly or yearly subscription. You simply make one payment and then you have lifetime access to the indicator, which also gives you any updates to the indicator, whether they're simply updates to the indicator or future versions of the indicator which add substantial new features or enhancements, and you have lifetime access, then you will also get those at no additional charge. We will be coming out with a new version of this indicator very soon, which will be the V3.0 version, which will have some substantial enhanced features added to it, which I can't go into at this time. But when that V3.0 version comes out in the very near future, the price of this indicator will be going up substantially. So if you do have an interest in this indicator, you can purchase it now at the lesser price and also apply the discount promo code, and then when the V3.0 is released, you will receive that version at no additional charge. And then also if any future versions are released after that with more features, then you will also receive those as well as any future updates at no additional charge as well. Okay, so thank you for taking the time to watch the video today. If you have any questions, you can either leave a comment or you can email us at daytradinggps@gmail.com. So again, thank you for watching today. If you like this video, please hit the like button, as it helps us out with the algorithm for the video. And also, if you would like to see more videos, you can subscribe to our YouTube channel, and you can be notified when we post any new trading videos. Again, thank you, and we wish you prosperity in all your future trading.